Get ready for the market action. Chip stocks are taking a massive hit as inflation data reveals the impact of energy disruptions from the war in Iran, causing a sell-off across the board. We break down exactly how this development is pushing U.S. yields higher and sparking serious questions about future interest rate decisions. Current dynamic is unsustainable. We explore the emerging trade where hyperscalers and AI deployment firms are poised to become the next major winners, moving beyond traditional semiconductor plays. And finally, we wrap up with the latest market pulse. We review the full picture of the inflation data, the sharp movement in the USD-JPY pair, and the aggressive rebound in oil prices. Don't miss these critical insights. Stay tuned for more breaking financial news. Chip stocks experienced a significant sell-off as inflation data highlighted the impact of energy disruptions stemming from the war in Iran, which subsequently boosted U.S. Treasury yields and intensified speculation about a Federal Reserve interest rate hike in 2027. The core consumer price index rose to its highest level since 2023, with the core gauge showing a sharp increase. This inflation data halted an equity rally, causing the S&P 500 to drop from a record high and the Nasdaq 100 to slide nearly 1%, with the semiconductor sector specifically sinking 3%. The surge in Treasury yields was fueled by renewed inflation concerns, leading traders to increase bets on a potential rate hike by the Federal Reserve in 2027. Meanwhile, U.S. crude oil prices surpassed $102, underscoring the role of high oil prices in driving inflation. Inflation accelerated in April due to rising gasoline and grocery costs, exceeding wage growth, presenting a dual challenge for consumers. The headline CPI climbed 3.8% year-over-year, the highest since 2023, while the core gauge increased by 2.8%. Market analysts are weighing in on the economic outlook. Brett Kenwell of eToro suggested that equities might need a pause following a powerful earnings rally, noting that while the labor market remains stable, a disjointed Federal Reserve and rising inflation complicate the situation. Skylar Wynand of Regan Capital pointed to stubbornly high oil prices as the dominant factor for the remainder of the year, stating that inflation is roaring back due to the Middle East conflict. Regarding monetary policy, Chris Zackerley of Northlight Asset Management indicated that given the inflation trajectory and a resilient labor market, it is unlikely the Fed will cut rates soon. Ellen Zentner of Morgan Stanley Wealth Management noted that the rise in core CPI confirms that high energy prices are impacting the broader economy, reinforcing the expectation that new Fed leadership will not immediately pivot to a dovish stance. On the downside, markets had already priced in rate cuts for 2026 before the report. However, Tim Urbanovich of Goldman Sachs Asset Management added that as long as the 10-year Treasury yield stays below 4.5%, it should not pose a significant headwind for equities. Geopolitically, President Donald Trump announced plans to prioritize trade discussions with Chinese counterpart Xi Jinping during his summit this week, downplaying the focus on the Iran conflict. Separately, UK bonds fell amid domestic political turbulence, as Prime Minister Keir Starmer survived a period of ministerial resignations without being forced from office. U.S. inflation has reaccelerated to 3.8%, triggering a downturn in equity markets, particularly impacting semiconductor stocks. The S&P 500 slipped by 0.2%, while the Nasdaq 100 experienced a more significant drop of 0.9%, largely due to weakness in the chip sector. In contrast, the Dow Jones saw a marginal gain of just 0.1%, and European markets also closed in the red. A notable exception was the U.S. healthcare sector, which performed strongly, gaining 2%, led by United Health, which rose by 3%. In the fixed income space, U.S. Treasury yields surged by 5 basis points across the curve, a reaction attributed to the inflation data and a soft 10-year note auction marked by a low bid-to-cover ratio. Meanwhile, UK 30-year yields reached levels not seen since 1998. On the foreign exchange front, the U.S. dollar strengthened broadly as expectations for rate cuts diminished. The British pound fell by 0.5%, becoming the largest decliner among major currencies amid ongoing UK political uncertainty. Commodities markets showed a positive shift, with oil prices rebounding aggressively fueled by fading ceasefire hopes. West Texas Intermediate, WTI, surged by 4% to break above the critical $100 per barrel level, and Brent crude rallied 3% to close at $107.70 per barrel. In currency trading, the USD-JPY pair demonstrated significant movement. Following a 4-day rebound of 1.8% from a low of 155.03 on May 6, 2026, the pair has reached the prior Japanese authorities' stealth intervention level of 157.9. Short-term momentum has recently turned bearish, with the hourly relative strength index momentum indicator flashing a bearish divergence condition in the overbought region during the U.S. session on Tuesday, May 12. Key resistance is set at 158.1, and a break below 156.5 could lead to further drops toward intermediate support levels at 155.55 and 154.65. Conversely, an hourly close above 158.1 could negate the bearish outlook, potentially leading to a squeeze toward intermediate resistances at 158.6, the 50-day moving average, and 159.1. AI chipmakers have driven the initial surge in the artificial intelligence boom, but Goldman Sachs is signaling a potential shift in investment focus, suggesting investors look beyond semiconductor stocks for the next wave of winners. The bank views the current dynamic, where chip companies post record revenue and profits, while other parts of the AI ecosystem continue aggressive spending, as unprecedented and unsustainable. Goldman Sachs analysts argue that chip companies should thrive only when their customers succeed, not at the expense of companies higher up the value chain. This perspective follows a prolonged rally in AI-linked chip stocks, spearheaded by companies like NVIDIA, as tech firms race to build AI infrastructure and data centers. The bank now anticipates that hyperscalers and AI deployment firms are poised to emerge as the next key winners in the AI trade. This shift is driven by investor skepticism regarding the returns hyperscalers are expected to deliver from their AI investments. Goldman suggests that if enterprises begin to realize tangible returns from AI spending, investors may reevaluate and pay higher multiples for hyperscaler stocks. Furthermore, the report indicates that hyperscalers could benefit if they scale back AI spending to improve cash flow, even if enterprise AI adoption remains challenging. This scenario could create pressure on semiconductor shares while boosting hyperscaler valuations. The primary risk to Goldman's forecast is continued massive investment by hyperscalers into AI infrastructure without corresponding meaningful returns from enterprise adoption. If this scenario materializes, semiconductor companies are likely to continue capturing the majority of the gains from AI spending. Asia opened to a mixed session as U.S. inflation reaccelerated to 3.8%, leading to a downturn in technology stocks. Equity markets saw declines across the board, with the S&P 500 falling 0.2% and the Nasdaq 100 dropping 0.9%, primarily pressured by semiconductor stocks. In contrast, the Dow experienced a modest gain of just 0.1%, while European markets concluded in the red. U.S. healthcare proved to be a positive sector, gaining 2%, with United Health rising by 3%. In fixed income markets, U.S. Treasury yields surged by 5 basis points across the curve, responding to the inflation data and a soft 10-year note auction, which was marked by a low bid-cover ratio. Meanwhile, UK 30-year yields reached levels not seen since 1998. In the foreign exchange space, the U.S. dollar strengthened broadly as expectations for interest rate cuts faded. The British pound declined by 0.5%, becoming the largest depreciating currency among major pairs, amidst ongoing UK political uncertainty. Commodities experienced a significant rebound. Oil prices surged aggressively on the fading hopes of a ceasefire, with WTI climbing 4% to surpass the critical $100 per barrel mark. Brent crude also rallied by 3%, closing at $107.70 per barrel. Forex analysis highlighted key technical levels for the USD-JPY pair. Following a 4-day rebound of 1.8% to reach 157.9, short-term momentum turned bearish, indicated by a bearish divergence on the hourly RSI momentum indicator in the U.S. session on May 12. Traders are watching the 158.1 key short-term resistance. A break below 156.5 could trigger a retest of intermediate supports at 155.55 and 154.65. Conversely, an hourly close above 158.1 could negate the bearish outlook, potentially leading to a squeeze towards intermediate resistances at 158.6 and 159.1.